Hello and welcome to the ESOP Centre's 8th Share Plan Symposium. The event is hosted by Baker McKenzie and I'm Juliet Wigzell and I manage the ESOP Centre at ZN Group. This is one of 9 presentations that will inform the 4 panel discussions at the in-person section of the symposium. This talk will be discussed as part of the panel on employee share plans in SMEs and private companies. Many thanks to David Craddock, who will shortly tell us about the valuation for employee share plans. There will be ample opportunity to put your questions and comments to the speakers at the symposium on the 5th of June, and we look forward to seeing you there. It's now my great pleasure to hand over to David. Thank you.
Well, thank you, Juliet. It's always a great pleasure to work with you personally and also with the ESOP Centre, and I'm very pleased to be invited to this event, which is to be held in London on the 5th of June. So my name is David Craddock. My business is David Craddock Consultancy Services, which I established some 28 years ago. As specialist in employee share ownership, reward management, share valuation, management buyouts, employee ownership trusts, EOTs, and investment education. And the subject which I've been requested to focus on today is share valuation. So let's go to the next slide. So the title I've given to this talk is Demystifying Share Valuation for Employee Share Ownership Purposes. If you remember, Churchill once described the Kremlin as a riddle wrapped up in an enigma, and it's often thought something similar in relation to share valuation. So what I'm seeking to do today is to demystify, to unravel the principles and to apply them specifically to employee share ownership models. Let's go to the next slide. Thank you. So demystifying share valuation, where do we start? Well, probably a good place to start is to understand the underlying principle which derives from statute. And it all really derives from Section 272 within the Taxation of Chargeable Gains Act 1992, where we have a definition of statutory open market value. That is what we're seeking to achieve when we establish a valuation position. We're seeking to achieve what's known as statutory open market value. And that is the price which those assets, so this section, Section 272, applies to any assets, but clearly our concern in relation to employee share ownership is shares, the price which those assets might reasonably be expected to fetch on a sale in the open market. And so we have statutory open market value. But we also have other terms. We have the term market value, which is sometimes used in the statutes, and we also have actual market value, which is especially used in relation to employment-related securities. Those terms, for all intents and purposes, are interchangeable, and so when we look at statutory open market value, actual market value, essentially we're looking at the same concept. It's the price, the best price that could be expected for the asset, shares or otherwise, on a sale in the open market between, and this is where case law develops that statute, between a hypothetical willing seller and a hypothetical willing buyer, on the basis that both are equally informed about the company. The information access is very important there, its activities and the market within which it operates, and that both the willing seller and the willing buyer are acting for self-interest and personal gain. Okay, so that's how the case law develops the statute, and a little bit more about the case law in a few moments. But you'll also probably be acquainted with this term restricted market value. Again, this comes up in the employment-related securities legislation, which governs our share scheme activity. Restricted market value is actually the same as actual market value. So actual market value is the value with the restrictions that are in place actually being in place for purposes of the valuation. So hence, actual market value is also restricted market value. Unrestricted market value, which also is a term found in the employment-related securities legislation, is a hypothetical value, and it's a value which assumes that the restrictions which are in place are actually not in place. And so therefore it is an uplift position on restricted market value, typically somewhere between 15 and 20%. From time to time, I do present to HMRC a position which is 10%, but normally somewhere between 15 and 20%. Good. Let's go to the next slide. Okay, a little bit more about the underlying principles. I've talked about section 272. We do also have section 273, and 273 applies especially to the SME sector in relation to the information which is available to the parties for purposes of entering into the transaction. And the requirement is, and I put it here in inverted commas at the foot of that slide, that is available to any prospective purchaser of the asset in question all the information which a prudent prospective purchaser of the asset might reasonably require if he were proposing to purchase it from a willing vendor by private treaty and at arm's length. So that information standard must be met in order to meet the application of the statute as interpreted by case law. Next slide, please. So this slide does elaborate a little bit more on the case law, and there is a lead case, and it's a case which went to the House of Lords, which was, of course, the predecessor to the Supreme Court as the ultimate jurisdiction for decision. It's a case of Re Lionel, Lynall, Re Lionel deceased. And it states, and this is in inverted commas, a hypothetical sale between a hypothetical willing vendor who would not necessarily be a director and a hypothetical willing purchaser on the hypothesis that no one is excluded from buying and that the purchaser will be registered as the holder of his shares but would then hold them subject to the Articles of Association of the company, including restriction on transfer, so the restriction on transfer provisions within the articles. And my comment is to say that the parties who are available for entering into the transaction for purposes of this hypothetical sale must be assumed to be very wide, typically anybody, anywhere. And furthermore, the restrictions contained within the Articles of Association must be taken into account in the formulation of the judgment. So we then come to the application of this case to section 272 in order to determine the tax value for purposes of capital gains tax. Clearly, TCJA, Taxation for Charitable Gains Act, is the statute which concerns the application of capital gains tax. Very, very helpfully indeed, the employment-related securities legislation, which came in some years later in 2003, uses the same definition for market value as we find in section 272 of TCJA. So typically, there's a need for a market in the shares, and HMRC's first port of call when they're looking to agree or establish a value is to ask, is there a market in the shares? Now, there might not be a market in the shares, in which case we have to look to other bases for establishing the value. But that will be their first port of call, is there a market in the shares? They would perceive there to be a need for a market in the shares in order to facilitate a position and to enable them to pronounce on this matter. However, for a tax value to prevail, as opposed to simply a contractual value, the capital gains tax treatment requires a transaction position that applies to any anonymous person with no special attributes other than wanting to sell, or wanting to buy, having the resources to buy, and being a prudent person. So by properly applying this criteria, the transaction cannot apply specifically to a category of persons, say to employees only or to directors only. It literally is anybody on the basis of meeting that threefold criteria. Let's go to the next slide. So when we come on to this next slide, what I've done is to summarize the principles which emerge from a combination of statute and case law interpreting statute that we need to apply in all of our share valuation deliberations. Point one, the parties of the transaction, the seller and the buyer, although they are both assumed to be hypothetical, they must also be assumed to be willing. So there must be an assumption of no coercion or force when it comes to the determination of the value in their deliberations one with the other. Two, in essence, it must be assumed that anybody from anywhere in the world can offer themselves as a potential buyer and make a bid for the asset, providing, of course, they have the resources to follow through on the offer. Three, the application of the principles is predicated on the assumption that all the preparations for sale have been made in advance, and there's no cost to be incurred in getting the asset ready for sale. Four, the best price must be assumed to be the best price that the buyer would be prepared to pay rather than the price that the seller would ask. So we all know people who say they want to sell their house, but they can't sell. Well, of course they can sell if they drop their price low enough to attract the buyer. So that's the principle which applies here. It's the best price which the buyer would be prepared to pay, rather than any aspirational value which the seller might be wanting to ask for the sale of the asset, in this case, of course, the shares. Point 5. The valuation must always give due recognition to market comparisons, and within that analysis, any special purchaser arrangements of significance. So, in particular, that's where we would go to the quoted companies in order to establish a value multiple. More of that in a few moments. And if there are any special purchase arrangements, what that means is if somebody comes in way above what is expected to be market price, but if they do have the resources to follow through and they're a serious buyer, and all the other potential buyers have to adjust their value offer accordingly, then that will classify as a special purchaser, and it will need to be taken into account in the hypothetical transaction. 6. The sale is hypothetical, even though the economic situation which prevails in the open market at the time is real. So whatever is the rate of inflation or the unemployment rate or exchange rate, if any of these impact on the decision, general economic conditions within the locality, for example, also is a factor to be taken into account. Any of those economic factors, they will be real, not hypothetical, even though the transaction is hypothetical. So it's a hypothetical transaction within a real economic environment. And then point 7, we must establish a date. The valuation must be determined as at a valuation date. It's the photographic point in time at which the transaction takes place. So clearly, you do have challenges to ensure the integrity of that principle, where you're actually working with a valuation which needs to be conducted sometime after the event. Clearly, what you can't do is build in the benefit of hindsight. It's the photographic point in time at which the transaction takes place. The pertinent case there is a case known as Reholt, H-O-L-T. Let's go to the next slide, thank you. So, they're the principles. What we have to do then is to work with surrogate positions in order to interpret those principles so that they can be realistically applied. They can be applied in practice. And as a general rule of thumb, we have various bases for that interpretation. We have earnings basis, we have net assets basis, we have trading basis, and we have dividend basis. It's sometimes said that in share valuation discourse that it's the highest value of those four which will prevail. Generally speaking, that's a general rule of thumb to follow, although there can be departures from that position. It's always a question of judgment, and HMRC, if there is a trading position, provided it's not superseded by subsequent trading, they will always give very high credence indeed to any recent share trading in the shares. There's also the offer basis. If a company comes in with an offer and it's a credible offer from a company wanting to buy, and they've got the resources to be able to follow through on the offer, then whether that offer basis is lower or higher than the other bases, normally the offer basis will prevail. Sometimes you get an offer which is subject to due diligence. In fact, usually it will be subject to due diligence. Not always, but usually. You need to take into account how far the due diligence has been taken. What stage are we in the due diligence? And maybe you'll come up with some sort of mixture of offer basis combined with, say, earnings basis, maybe some previous trading as well. Okay, so bear in mind what we're seeking to do there is we're seeking to develop bases which in a very practical way apply the principles which are established through statute and case law. Let's go to the next slide, please. So, a few case studies. So, I'm the technical secretary of the Leeds Group. The Leeds Group, Leads, is a group which was established some years back. I established it with a number of other practitioners to meet with HMRC, typically 2, 3, sometimes 4 times a year, in order to discuss various examples, various case studies on the interaction between employee share ownership and share valuation. So we can get their sense of how they respond to these examples or case studies, and we're working very strongly now to be able to publish. One would certainly hope this year, and I would dearly like to think it would be by the end of the summer. So this is case study number one, earnings basis for whole company value. So when we're working with an earnings basis, we need to establish a whole company value by multiplying a sustainable profit position by a value multiple. So in the first instance, we need to establish that sustainable profit position. And in this example, what I've indicated is that although there were 350,000 profits in 17, from 18, 19 and 20, there was upward trend. So upward trend would indicate that we're going to use the last position, even though there may have been a higher position some 4 years earlier. Within that 3-year period, there is an upward trend, and so we're taking 330,000 as the sustainable profit position in this case study example. We multiply that by a value multiple, so it's a price earnings position, yeah, price earnings, price being value, earnings being profit. So we work with that ratio to multiply the sustainable profit position by the value multiple in order to produce the value. Okay, so the value multiple will typically come from researching price earnings ratios in the market, in the quoted sector, taking a basket of those price earnings ratios, companies in similar or same trade as our client company. So with that basket, we say arrive an average. We might do some weighting within the quoted price earnings ratios, but we will arrive at some sort of average position to which we would apply a discount, and that discount can vary. In this example, I've applied a discount of 50% in order to account for lack of marketability, the fact that there's less asset backing for our company, the fact that the company is less diversified and smaller than the quoted comparator, but most especially the lack of marketability in the share. So we take a discount of, in this example, and I emphasize it's an example, 50% in order to recognize that principle. And then we add back a bid premium of somewhere between 10 and 20%. The reason for the bid premium is to reconcile that all indices and measured positions, whether they be share prices or price earnings ratios, that come off the quoted market are in relation to minority positions. And we're seeking to establish a whole company value for our company. So we add back a bid premium to take it from minority to whole company. And that gets us, in this example, to a value multiple of 8.59. Multiply 8.59 by the 330,000 profit figure, and we have a whole company value of 2.8 million. We then need to compare that with the net assets of the company. In this example, they are 1.5. And so because the whole company value on an earnings basis produces a higher value, we work with that 2.8 for whole company value rather than the lower net asset position of 1.5. The difference, of course, between the two is goodwill. It indicates an efficient use of the net assets to produce a whole company value on an earnings basis, which is by some measurement higher than the net asset position. So once we've established our whole company value, we can divide by the number of shares to produce a pro rata value per share, and then we can apply our minority interest discounts in order to establish a minority interest value. More minority interest discounts as we move forward in this presentation. Next slide, please. So on this next slide, we've got case study 2. Same methodology, really, in order to produce the numbers as in case study 1, except in this case, the asset basis is higher than the earnings basis. The whole company value from an earnings basis produces a whole company value of 3.4 million, whereas the whole company value on an assets basis produces 3.7 million. That's a net assets basis as prepared from a contemporaneous, as derived from the preparation of a contemporaneous balance sheet. So net assets 3.7, having accounted for some revaluation of property on that balance sheet, 3.7 compared to 3.4. We therefore use the net assets basis position and apply the minority interest discounts to that. Next slide, please. This is case study 3. Share trading. Well, what I'm seeking to illustrate here is that the company could be making losses, and in this example, it definitely is making losses, and it may never ever have made a profit. So the balance sheet shows net liabilities, but the company can still have a value. I mean, the balance sheet might actually show a profit figure through. The balance sheet may show a positive assets figure through cash which has been accumulated through subscription of shares, even though there are no distributable reserves arising from the development of profits year on year. Let's just suppose that the company's never ever made a profit. So we have a look at the balance sheet, look at those subscription monies, divide by the number of shares in issue, and that gives us here a value of 0.0041. However, there is a share trading basis. The shares have been trading at 0.0354, okay, consistently so, and that is on the basis of a value which has been attributed to, in this particular example, intellectual property. So we work with that share trading basis of 0.0354 as the value for the shares, even though the company may never ever have made a profit, and the company would show net liabilities, but for the fact that there's cash received by way of subscription monies. So let's go to the next slide, case study number 4. This is a very interesting one. This is the growth share model. There are many, many ways to cut the cloth for a growth shares model. Many ways, and I signed off one earlier today, which was not like these two I'm going to share with you. Growth share models can be varied and many in their design, but in this particular example, let me just take you through how I've worked it here. Sustainable profit figure of 50,000, a value multiple of 8, so we have a whole company value of 4 million. We freeze the whole of that 4 million into the existing share capital of the company. So that 4 million will always be the start point for attribution of value to the existing share capital. So we then issue new shares, which are the growth shares, at a very, very low value. Why are we able to do this? Because there is no value in the whole company value that we've established for the company, which can be attributed to the growth shares. It's all locked into the freeze position for the existing share capital. However, we might still attribute a little bit of value to the growth shares on the basis of hope value. Although if we've got a hurdle which is in excess of existing whole company value, let's say somewhere between 10 and 40%, then we might take the view that that premium in the establishment of the hurdle does actually negate any tax liability that might arise on the issue of shares for the growth shares. So very, very interesting to develop these growth share models, and that is one way in which to actually establish a growth share model, working with a freeze, and then I've just introduced you there to the concept of a hurdle, though it's not actually in that example. Let's go to case study 5. Case study 5 is another growth share model where we value using discounted profit or cash flow analysis. So in this example, we determine a value multiple of 10, and we establish a discount factor of 20. And that's made up of composite elements, risk-free rate or return of 1.4% based on research money markets, risk premium for private equity investment of 5.6 based on published premium positions, risk premium for small and non-diversified companies, let's say 8% for a startup, risk premium for share illiquidity, lack of market in the shares, let's say 5%. Seeking to base these composite elements on research positions, research sources, wherever possible. That produces a discount factor of 20. So how do we then generate the whole company value on an earnings basis using discounted cash flow models? Well, we project forward, let's say 5 years for profit after tax, assuming a realistic growth rate, whatever that might be, pertinent to the company that we're working with. So we project profits forward for 5 years. We apply the value multiple of 10 to the projected position after the end of the 5 years. the resultant figure therefore is a whole company value projected forward at the 5-year point. We then discount that whole company value back to the present point in time so that we have a net present value. Yeah, and we do that using the discount of 20% per annum, going back from the 5-year projected point to our current point in time, and so we have a net present value. That gives us a discounted whole company value to it. By discounted, I'm talking about discounted profit flow profit flow cash flow analysis. So we've got a whole company value to work with, to which we can then apply minority interest discount in order to establish the minority interest for share scheme purposes. Okay, don't get confused between my use of the term discounted flow for profit or cash and the discount which we apply for minority interest. The discounted profit or cash is in terms of the discount factor of 20%, which we're using to take our whole company value from the 5-year projected point to the current present point. We then apply to that discounted whole company value minority interest discounts in order to determine minority interest values. Let's go to the next slide, which is a reference to special purchaser. It gets quite a good say in the international valuation standards, the concept of a special purchaser. And it's this situation where, let's say, and this has happened to me on various occasions in practice, I value the company at, let's say, 20 million, but then suddenly a potential purchaser emerges offering 60 million. And back in 2018, we had an example with exactly these numbers, and the company which offered 60 million did in fact ultimately take it to 75 million, and they won the day and bought the company. They really wanted the company. They were truly a special purchaser. So let's just think in terms of how this is working. Well, it's the application of Reliable as before. Special purchaser offering to buy the shares, special purchaser financially able to buy the shares at the enhanced price, and that fact is known in the open market. Sometimes these cases get to court. So there are some very interesting cases which interpret Reliable in the context of special purchaser. The courts will require clear proof of the situation of special purchaser before weight can be given to it as the basis for the decision. Okay, let's go to the next slide. Enterprise value versus equity value. Enterprise value is, of course, a position where you're working with EBITDA multiplied by a value multiple. Equity value is where you're working with price earnings ratios applied to net profit. It's clearly possible to reconcile the two, and what I've provided here is the mathematics which actually shows how the two do in fact reconcile. So all these slides are available to you for you to peruse at your own time and hopefully derive value. I'm trying to give you value for money. Yeah, value for money. You like that? Yeah, value. A presentation on valuation, delivering value. So you can look through these slides and come back to any questions that you have. Let's go to the next slide. These are the minority interest positions. Well, this is actually the percentage control and how we actually establish control in terms of whether or not there's a capacity to actually block special resolutions or indeed to pass special resolutions, to block ordinary resolutions or to pass or to pass ordinary resolutions, and what sort of level of interest there is. So for our employee share schemes, typically we're looking at somewhere down at the bottom here, percentage shareholdings of less than 25%, where there is some control, maybe through influence, but very little. Let's go to the next slide, where you've got the levels of discounts which typically would apply. So at the bottom of the ladder there, less than 25% shareholding, the level of discount would typically be somewhere between 50 and 75%, typically at that top end, somewhere around 75, and sometimes may even go to 80 or 90 in very rare circumstances. Let's go to the next slide, just to round off some final tips for share valuation. Firstly, the predominance of share trading. HMRC will always give emphasis to any trading in the shares, although that can in circumstances be overridden if the earnings value can demonstrate a higher value and the trading position is seen to have been superseded. Two, the offer basis. A genuine offer will trump other bases, whether the other bases are higher or lower than the offer basis, although care should be taken to determine the status of the due diligence as an influencing factor. Three, one value for one transaction or for the same transaction. There can only be one value for the transaction, and that applies to both the seller and the buyer. And so what I'm saying there is there cannot be different values for the same transaction undertaken by the same parties. There's one value for the transaction. Four, rights and restrictions of the seller or the transferor. So when setting a value, always examine the rights and the restrictions of the shares in the hands of the seller before the sale or transfer, i.e. where the shares have come from. Okay, because that's the actual empirical position as what the share consists of. It is a bundle of rights and restrictions as currently is existent in the hands of the seller or the transferor. Five, the already determined values. HMRC have a tendency to look at any determined values from any class that's been established over, let's say, the last 3 years when they're looking to establish a value off their own bat. So do be aware of that. That can often catch out a valuation if it actually does get raised by HMRC and they raise questions. Six, the purchase of shares by the majority shareholder. A majority shareholder will normally not buy additional shares at a minority price. That's just something to be borne in mind. And then this final slide of points. Let's go to the next slide. Articles of Association. The provision of the articles form part of the hypothetical transaction as envisaged by section 272 and provide the basis for a tax value where the hard wiring into the articles applies to anybody anywhere in the world. So you need to look very carefully to make sure that there is a hard wiring in order to apply that principle. Furthermore, the integrity of the articles should be respected as the constitution of the company and the basis for order in its activities and undertakings. That said, if there is a share trading position recently and it's not superseded by the earnings basis, and it doesn't comply with provisions which are hardwired into the articles, the share trading position could well prevail. 8, the influence of voting rights. So although voting rights for minority shareholders do not attract value, HMRC, in my experience, they seem to take the view that if the employees have voting rights in a separate class, even when all other rights compared with other classes are the same, the shares will have an enhanced value. Treatment of excess cash. Clearly, this doesn't apply if you're working with an assets basis because it's whatever cash is there is already within the net asset position. But if there is excess cash over and above working capital requirements, that will typically be added to the value determined on an earnings basis for multiplying profit by value multiple. You typically add back any excess cash on top of that. And internal markets, last point really. The last trading price for sales to an employee share trust provides the start point for the price setting for the next transaction. Well, the time lapse since the last transaction should be accounted for. As a general rule of thumb, there should be congruence between selling prices and purchase prices for the employee share trust transactions, and congruence between the bases for determining those prices. From a trust law point of view, of course, the trust should never buy above market value, otherwise there's a breach of trust. That's all the principles I'm very happy to share with you today. Let's just round things off in the this is my best wishes slide. Best wishes to you for your business initiative on employee share ownership and share valuation. Any questions, do feel free to let me know. We're greatly appreciative at the ESOP Centre of our ESOP Centre sponsors, which are related there on that slide. And indeed, we look forward to seeing you, as indeed I personally look forward to seeing you at the symposium to be held next week, Thursday, the 5th of June, 2025, at the offices of Baker McKenzie. Thank you very much for listening, and I look forward to receiving your questions and answering them next week when I should be present at the symposium in London. Thank you very much indeed, and all best wishes to you.